RVW presentation. It's a great pleasure for us to have you with us. We have people from all over the country and indeed all over the world. What a terrific turnout of people who are anxious to know what JP Morgan thinks and what we think by inference based on those shoulders and other shoulders on which we sit about the current situation. It's a great honor for us to have a very distinguished speaker, but I will leave that to Peter Duan, who's going to be introducing him. Just a quick word about how we see things now from a 10,000-foot view. RVW is a very different CPA, a very different wealth management firm. Born out of a CPA firm in 2005, we are data-centric. We look at the numbers and we're a bunch of quant jocks. And the person following me, one of our senior quant jocks, one of our senior analysts, Peter Duan, will tell a little more about how we see things. But for now, just know that one of the quotes from Warren Buffett that kind of guides our ship is he says there are two kinds of people at a sports event. There are those who keep their eye on the scoreboard and those who keep their eye on the playing field. Everything we do at RVW is about focusing on the playing field. And that said, it gives me great pleasure to introduce Peter, part of our team, Senior Wealth Advisor, Vice President, to introduce the speaker. Thank you all for coming, and I hope you will find this to be informative, brief, concise, and actionable. Thank you so much.
Well, thank you so much for that warm introduction, Selwyn. Like Selwyn said, my name is Peter Duan. I am a wealth advisor here at RVW, and it's my pleasure to give you guys our high-level overview on what we think has been going on in the markets. Let me, in the meantime, share my screen. Just give me a quick second. Right. Okay, perfect. Perfect. Okay, I hope everybody can. I hope everybody can see my screen. Okay, so at RVW, we are known as almost perma bulls or perma optimists, and there's good reason for that with the data that I'm about to show you. So this is a chart of the S&P 500 since 1970. The S&P 500 is oftentimes known as the stock market or the U.S. stock market. And so if you were to invest, say, $10,000 at the beginning of 1970 and held that till today, that $10,000 would have grown to roughly about $2.75 million. And what I wanted to highlight in here is I highlight that during this entire time, obviously, there's going to be a lot, or there has been a lot of important international events. Some of them I've highlighted in red here that caused the market to have significant corrections along the way. So some of them like the Black Monday event, the 9/11 terrorist attack, Lehman Brothers collapsing, and even COVID. And despite all of that, the market has continued to rise throughout this entire time. Here's another interesting chart that we like to show. The market on average has declines of up to 14% during the year. So if you were to look at this chart in color the black, it's the year-end total returns, while the bars that are in orange shows how far it draw down during its maximum drawdown during the year. So for instance, if you look at 1980, the total return for that year was 26%. However, during that periods of the time, it went down 17% within the year. So all in all, it means that despite that you will always get during the year volatility, but if you were to be held consistent throughout your time as an investor, you will be rewarded. And this is another way to view being rewarded as an investor. So I really like this statistics right here that shows that the average bull market period lasts about 4.3 years with a cumulative return of about, call it 150%. This is compared to an average bear market, which lasts about 11 months with a cumulative loss of 31%. So if you were to just take a glance at this, you'll see that the periods of bull markets significantly outweigh the drawdowns of the bear markets. And that's about, call it a 4 to 4.5 times more likely that you're going to be in a bull market versus a bear market. I think this is something interesting to show that even during periods of recession, we can still be in a bull market. So for instance, these gray lines indicate periods of recession, but you can see that despite these periods of recession, there were still persistent bull runs shown here, here, and even here, for instance. Well, that's all I have on my end. I'm happy to now turn this over to Jack at JP Morgan, who will give you even more color on the markets.
Wonderful. Well, thank you very much, Peter, Selwyn. Thank you, everyone at RVW for the invitation. And thank you, everyone on the line for dialing in and spending some time with us, whether it's the morning, afternoon, or evening for you on this call. I was so thrilled to hear that RVW considers themselves to be something of perma bulls, because I certainly consider myself to be in that camp too. You know, a lot of people are surprised to know this, but despite the fact that I am what is referred to as a global market strategist at JP Morgan, and in that capacity serve in some instances as an economist, I didn't actually study markets or finance or econ in college. I studied history. And if you're looking at history, you will recognize that if you are not a bull in this space, you are fighting against hundreds of years of market history and thousands of years of human history. It is always the wrong side of the trade to be on. And I think as that long-term bull, you can think about some of the more recent market volatility with a more constructive framework. You know, whenever I have conversations about investing, about the markets, I think that there are a couple of steps that you need to take in order to land at that point where you can actually have something smart to say about what's going on with stocks or what's going on with bonds. You know, one of the most important things that you can do, perhaps the most important thing that you can do, is have a view on interest rates. And when I say interest rates, I mean the Federal Reserve and what they're planning on doing with monetary policy. You know, the cost of money matters a lot. It may, in fact, be the single most important variable if you're trying to have a view on what's going on with markets. But if you want to have that view on interest rates, well, you have to understand what's going on with the economy. Because when the Federal Reserve meets, like it did just about a week ago, it holds a press conference, it issues a statement, maybe it does something with interest rates. You know, it's doing those things in response to underlying macroeconomic variables. The Federal Reserve is paying attention to growth and employment and inflation. And so we need to pay attention to those things as well if we want to have a view on markets. And so that's where I'd kind of like to start today's discussion, putting this volatility into context, thinking about what's going on with the economy. And so let's turn to the next page of this presentation, please, and start with what's going on with GDP in particular. Because all of a sudden, over the last few days, the conversations are echoing the ones that we were having really at the start of 2023, namely the risk of the United States entering into a recession. Right? Anybody that dialed into a call like this at the start of last year was met with an overwhelming consensus sentiment that the United States was going to enter a recession in the back half of 2023. And yet we were defying those odds last year. We didn't enter a recession. And not only did we defy those odds, defy those expectations, we in some cases defied gravity. Now, people thought that the economy would slow down, that we would see the Federal Reserve capitulate and cut interest rates, that the equity market would collapse. In reality, none of those things happened, and our economy actually sped up. You look at the table on the left-hand side of this page from our guide to the markets, you'll see the third quarter GDP growth was almost 5%. That's a number you'd expect to see out of China, not out of the US. Fourth quarter GDP growth, almost 3.5%. Even in the first half of this year, GDP growth still running right in line with trend. This has been, for 18 months, an economy against all odds, firing on all cylinders. And if you want to figure out where that unexpected resilience in the economy came from, well, you have to look at the right-hand side of this page. We break out GDP into its various subcomponents, and you can see that the engine of growth in this economy is consumption. It's people like us going out there and spending. And so unexpected growth in the economy must then be linked to unexpected resilience, in the economy must then be linked to unexpected resilience in the consumer. And if you're trying to figure out why the consumer has done so well, a lot of that comes back to the labor market, jobs in this country, and how tight that labor market had been for so long. And when I say a tight labor market, I mean that every month we were adding hundreds of thousands of jobs to this economy. Every month we were looking at an unemployment rate, if not at all-time lows, and floating pretty darn close to them. Every month, wage growth that was handily beating inflation for the first time in decades. All of this meaning that the labor market is tight. And there are undoubtedly a lot of things that consumers are dealing with right now. Higher prices, higher interest rates, geopolitics, domestic headlines. But in the face of all of these issues, most consumers that wanted jobs had them. And not only did they have those jobs, but they were satisfied with the wages that they were getting paid, and they were confident that they would be able to hold those jobs in the future. And that's why this engine of growth kept on turning, why those odds were defied. And that's why Friday's jobs report threw so much cold water on this equity market, because those numbers came in a lot softer than expected, prompting people to wonder, were we wrong last year? Was that recession that was so predicted not actually avoided, but simply delayed? And all those concerns stemming from the fact that job growth was worse than expected. Downward revisions to April, May, and June numbers. Wage growth cooling more than we would have liked. And the unemployment rate ticking up 0.2 of a point to 4.3%, as high as it's been in probably around 2 or 3 years. But I'm actually not that concerned about that job report, not just because one print doesn't make a trend, but because if you open up the hood on that job report, you'll see there's a lot more going on underneath the surface. Let's turn to the next page here, please, where we can dig into that just a little bit. I want to make the point that in July of 2024, that's the job print that we got this past Friday, people weren't losing their jobs. And while job gains were worse than expected, they were still pretty good. Almost 120,000 jobs added to the economy in the month of July, with the 3-month moving average trending modestly lower to 170,000. Yes, the economy is losing a bit of steam, but we are still growing. And if you're trying to figure out how you can have job gains, but an increase in the unemployment rate, well, you have to look at the bottom right side of this page. Participation in the labor force has been steadily increasing. More and more people entering the labor force looking for jobs. And they can't find them, right? And it's not because there aren't any jobs out there. There are plenty of jobs. There are millions of jobs. There are, in fact, more job openings today than there were even before the pandemic. But maybe they're in the wrong place. It's the wrong time. The skills don't line up. For whatever reason, we cannot match those new job seekers to those existing job openings. Is that good? No. Is it perfect? Certainly not. But it also feels sort of symptomatic to me of a tight labor market. You know, everybody that wants a job, or everybody that has a job, I should say, has confidence that they're not going to get fired. Layoffs are still staying quite low. But if you're entering the workforce now, most of those good jobs, they've already been taken. So you have a harder time finding that source of employment. I think very clearly the U.S. economy is slowing down. We knew it was going to. That pace of growth achieved in the back half of last year was simply too strong. But just because we are shifting down into a lower gear doesn't mean we are throwing things into reverse. And I still don't see a recession materializing over the next 12 months. Which brings us now to the next page in this presentation, which is to have a conversation about that other big macro force that we need to focus in on. And that, of course, is going to be inflation. For a while, the most talked about economic subject out there, now very much taking a backseat to concerns around labor, thanks to this past Friday's jobs report. But it is still important to understand what's going on with inflation. And if you look at inflation over the last couple of years, very clearly inflationary forces have shifted. If you look towards the middle of this page on the left-hand side, you'll see 9.1% inflation. That is June of 2022. It is the highest inflation has been since January of 1981 and represents the high watermark in inflation through the cycle. Think about what was going on around the world in June of 2022. Russia had just invaded Ukraine, two very large producers and exporters of commodity products. And we don't know how the war is going to disrupt those supply chains. We panic about scarcity and prices go up. At the same time, China is embracing zero COVID while the rest of the world learns to move on and live with the virus. School is reopened, work is reopened, we're taking vacations, we're going out to eat once more, but China remains under lockdown. Their manufacturing activity is hamstrung, and any finished good you're trying to get your hands on becomes harder to come by. It's not a perfect way to think about this, but an interesting thought exercise nonetheless. Look at that 9.1% read, and now remove energy, which I'll take as sort of a proxy for Russia. Purple or food, which I'll take as sort of a proxy for Ukraine. And orange are goods, which I'll take as sort of a proxy for China. And that 9.1% read drops all the way down to 3.5%. A very different environment. And in fact, that is exactly what happened over the subsequent 12 months. We removed those things from the narrative. The war in Europe is not over, but supply chains got rerouted. Russia used to be Europe's largest provider of natural gas. Now we are. And China managed to reopen its economy, it didn't stamp out COVID, but it abandoned that policy. Their manufacturing activity has picked up once more. And energy went from being inflationary to deflationary. Inflation in things like goods and food essentially zeroed out, and inflation was crushed from 9.1% to 3.0% in 12 short months. But the 12 months after that, from June of 2023 to June of 2024, that's been a bit tougher. It's been stagnant. There's been no progress made on inflation. And that's because the stuff that's driving inflation today is a lot stickier than the stuff that was driving inflation 2 years ago. It's not supply chain problems in the way that it used to be. In fact, the single largest contributor to inflation right now is shelter. It's the dark blue bars on the right-hand side of this page. And the funny thing about shelter is that while it may sound like shelter prices should equal home prices, in reality, that is not the case. Shelter in this calculation actually represents rent. And while the Federal Reserve was busy raising interest rates more aggressively than it had in half a century, from March of 2022 to July of 2023, it put upward pressure on mortgage rates, made home ownership unaffordable, and forced people that would otherwise be buying their homes to rent them. And it is no coincidence that over that same time period, median rents in this country increased by over 10%. Now, when you think about rent and realize that it reflects a lagged reality, nobody signs a 1-month lease. They sign a 12-month lease or a 24-month lease. You will recognize that the shelter numbers that we are looking at today actually incorporate leases that were signed a year ago. In other words, it's going to take a little bit more time for those old leases to roll out of the calculation. But I am optimistic that inflation will continue to grind lower, and that 2.0% is very attainable at some point over the next 12 months. Which brings us now to the next page here, which is to say, well, okay, now what does all of this mean for interest rates? And on Monday, there was a massive course correction in how markets are thinking about interest rates. Just a little over a week ago, the market thought the Federal Reserve was going to cut by 25 or 50 basis points this year. Fast forward to this past Monday, just a couple of days ago, a few days ago at this point, the market's no longer talking about 25 basis points or 50 basis points. The market is in full-blown panic. It thinks that the U.S. economy is heading into a recession because of that jobs report, and we're not talking about 25 or 50 basis points of cuts. We're talking about 125 or 150 basis points of cuts. The Federal Reserve being forced to enact emergency measures and throw a lot of gasoline on this fire to restart the U.S. economy. Hence all this volatility that we've seen in markets over the last few days. But I think that cooler heads will prevail. And I think that market expectations for interest rates are probably overdone. But I also think that the Federal Reserve is certainly going to cut interest rates this year more than had been previously telegraphed. And with that in our back pocket, coupled with the macro outlook, I think it is easier to now move on and have a conversation about what all this means for investing. So let's turn to the next page here and start our conversation by talking about bonds. You know, I always like to start with fixed income because I think it is a unloved asset class. You know, so many investors looking at the bonds in their portfolios and wondering, why would they own this stuff? You know, for a long time, there was no income to be found in fixed income. And then when the income finally does show up, it's because the Federal Reserve is hiking rates, and bonds go from doing nothing in your portfolio to actively hurting them. Now, all of a sudden, we're hearing questions like, are bonds broken? Is the 60-40 dead? Do we no longer want to be diversified? That's not the right way to think about this. Bonds are not broken. They are simply misunderstood. You know, we have conditioned ourselves to think of fixed income as protecting us against the equity market. Stocks sell off and bonds go up, right? That's why you want to own this stuff. But that has not really been the case over the last few years. Stocks and bonds moving in the same direction in 2022, in 2023, and so far this year as well. That's because bonds do not protect you against the equity market, but instead protect you against the economy. Where if my outlook is wrong and we do enter a recession, the first thing the Federal Reserve is going to do is cut interest rates. And when interest rates are falling, the value of any existing fixed income instrument that you own goes up. And that's how you make money in that fixed income insurance policy. And I don't think there is a better chart out there to illustrate that point than the right-hand side of this slide from our guide to the markets. It looks at the impact of a 1% change in interest rates on the total return of all these different parts of the bond market. The blue bars represent what happens if rates are falling. The gray bars represent what happens if rates are rising. And very clearly, the risk-reward profile is uneven. It's asymmetric. There is more upside potential than downside risk. And while there may be some short-term uncertainty about what happens with interest rates because the data are continuing to evolve, there's a lot of long-term clarity on what will happen to interest rates, which is that they will move lower. So we should feel comfortable owning fixed income in our portfolios, short to intermediate duration, high-quality instruments, because of the ballast and protection that it can provide. Turning to the next page, we can spend a little bit of time on the equity market, which of course is the most exciting thing that's going on this week. And I think it's where I'll leave you all from a commentary perspective. You know, this has been a wild ride over the last not just few days, but over the last 18 months. You know, the S&P 500 since the start of last year is up around 40%. And yet, despite the fact that if you invested in the stock market at the start of last year, it has made you very, very rich, so many of us have not fully bought into the rally. We think it's come too quickly, too far. We think that it's too focused, too narrow. It's just the Mag 7. It's nothing else. The valuations are out of control. Earnings expectations, price for perfection. We are constantly trying to poke holes in this narrative. And in that sense, Monday's volatility was a continuation of that theme. Outsized reactions from equity markets to relatively small misses on macro data points. But if we put aside recession concerns, as I think we should, at least for now, we can zoom out a little bit and remember that while Monday was the worst day for the market in a while, that sell-off was not off of all-time highs. In fact, by the time Monday rolled around, the S&P 500 was already a few hundred points off of its all-time high, and that the real rotation had begun in earnest, not on Monday, but 2 or 3 weeks ago, after the June inflation report, when everybody started to realize the Magnificent Seven may not be everything that it's cracked up to be. And again, when we remove recession concerns from the equation, we are looking at now a very interesting and in some cases supportive macro environment. Wage growth is easing. We saw that evidence this past Friday. Inflation is cooling. I talked through some of those dynamics that will push inflation lower. and interest rates are moving down. And in that environment, when all those things are happening at the same time, you no longer have to be the Mag 7 to make money. And we know that over the long run, markets, earnings drive markets. And if we look at the top right side of this page, we are expecting the other players on the team to finally show up to the game and start to compete. It's not about the Mag 7 versus everything else. Earnings growth is expected to broaden in the back half of this year. And what that means is that I can stay constructive on the equity market. I can continue to be a bull despite the volatility that we've seen over the last few days. But the way that I do it is by remembering that it's not just about investing in AI in the Mag 7. It's about fishing in a bigger pond. It's about casting a wider net. And it's about embracing active management and security selection to find those winners, isolate them away from potential losers, and generate returns in a long-term portfolio. So with that, I'd like to thank you all very much for the time, the consideration, and Selwyn, I will pass things back over to you.
Thank you very much. Wow, Jack, that was a masterful presentation. All of us at RVW and the viewers, as I said, from around the world have learned a great deal from you. And to those of you who are watching who are clients, please call your advisor or me, or email if you have any questions. And for those of you who are not clients yet, shame on you. We're waiting to welcome you aboard. Thanks, everybody. Have a wonderful rest of summer, and we will be back in touch soon. Thank you.